Hello, this is Peter with Quantum Edge AI. What I've wanted to do today is structure some interesting option logic. Now, it these trades become overlooked because they're somewhat complicated, but they minimize risk and they are advantageous due to its structure. Now, if you look at the Thinkorswim location, the window, you see that there's a diagonal along with a out of the money put. The reason why you'd want to do something like this is because you're really minimizing a ton of risk. Now, in the event of absolute collapse, you're profitable. In the event that it gaps up 10, 20%, you're not taking a massive loss. You want to be in this Goldilocks zone where price is just highly likely from day to day just being in this threshold from here, from around 560 area to all the way to 603 above here. The way you can structure this too is by optimizing it such that your lower threshold is below the low forecast and your highest threshold is in this area where the high forecast is. So we can do that. It's currently not structured this way now, but we can do that by adjusting these in such a way that it makes this decline further. So what we want to do is the long call to be in or at the money, and for the short call to be closer. Now, we don't really want this short call to be in the money. So what would be optimal would be to place this short call in the close forecast location. So maybe somewhere around the 575. And then we can adjust this like so. 565, it's the at the money. The benefit of this trade is that you have long delta, which means that with price movement increasing, your P&L will be increasing. And also you have this nice area of theta where you're going to be capturing theta decay. And what that means is as time goes on, your position, in this case, it will be a net debit, will increase in value. The reason why it does this is because your short call will be generating income while your long positions. So basically the theta arbitrage is the long position, the long call and put will not be losing as much theta, as much value as your short position. And that's what generates the long theta decay. This structure is quite nice because in the event that it does collapse, you are taking a potential long P&L. Your P&L is actually increasing in the event of a catastrophic loss of the stock itself. And you're also benefiting in the event that it increases, or even in the event that it completely gaps up. So say for example, price gaps up here. It it blasts through the high forecast, and now it's in a location that is way over here. Well, you're still profitable over here. Your P&L is still positive. And that's the type of trade you want to be in. You want to be in a trade that you're not sitting in taking consistent losses. So you can compare this to the long vertical, and you can say, Okay, well, the typical strategy in this case for most beginners is taking this long vertical. You're saying, okay, I'll buy the long call. I'll sell the next call at say 590 where the high forecast is. And wow, on in terms of P&L, that looks fantastic. Oh, wow, you have a sometimes you have to reset this. Okay, so disregard this P&L here and disregard this P&L. This is shifted upwards because it was a locked. Okay, so disregard um, this structure in a way because if you think about it, price is currently here. And what does that mean? If price is at this location, where is this teal line? This teal line is negative 468, which means that you're paying to be in this trade and you're losing money as long as price is below 579. So this whole time, when you are below this location, 579.91, somewhere around there, 579. As long as you're below this locate, price is below this location, you're going to be losing money. So for most, for the long, for expert and professionals, they're not going to sit in a trade and just lose money. They can't. Your whole book can't revolve around having this theta decay being negative. You have 10 trades, and say 10 trades, even at one contract, you're going to be losing $210 a day. That is not advantageous. What you want to be doing is structuring trades that have a high probability win scenario that generate theta decay and it depends. You don't have to put on this long hedge. You can maybe put a portion of this hedge on and you have this interesting um, structure where you're not going to get killed on the way down if in the event of a absolute collapse, another 5 to 10% movement down. It's already moved substantially. So in the event that this happens, you can you're not going to wait and sit in this position. You're going to get out here. My advice, what I would do, this is not investment advice. This is just what I would do in this position. If I was taking this position, what I would do is have an exit for at this location at 5:30. In the event that over the next week Meta decides to dip below 5:30, you're out. You're going to take your $560 loss and you're going to move on. You're going to close the position and find a new trade. But to me, this is an advantageous area. You have long delta, you have long theta. And also another thing that, you know, goes overlooked is in the event of an absolute collapse, Vega volatility will increase substantially, and you will actually profit from the volatility spike. And that's when you want to exit the position. You want to exit, and you can actually simply exit this call and close the gap down and be profitable there. But then you still have this, in the event that it continues to cascade, and decreases price, you're going to be losing on the way down here. So you can keep your hedge, or you can or lose your hedge, and you'll be more delta positive. So in the event that it does decrease to 530, you can remove the put hedge, and then as price maybe rises back slightly, you can close the diagonal. This is a nice structure because no matter what, whether you have the put hedge on or not, you're going to be theta positive. Now, another thing is you can increase the put location, the put contract size. And look what happens here, that you decreased your risk substantially. Now your total potential loss, if you hold it, your potential loss is 1200. You do not hold this position. You close this position always before expiration at 11.9 in this case, a week from now. But your total P&L in the event of an actual delta move is this. Now, in the event that this actually happens, your Vega is going to be increasing exponentially. So in the event of a volatility spike, you're actually going to be making money here. You're actually going to be positive. Your P&L is going to be positive. Even though the delta, it looks as if it's going to be negative, your P&L is actually going to be positive because of this Vega spike in the event that it collapses and implied volatility increases. Now, we can do another thing here, and we can adjust the volatility and say, well, in the event that volatility increases 10%, what happens if volatility increases 10%? Disregard this, it says 30, negative 33.84, but it's not true. In the event of a volatility increase of implied volatility increase of 10%, you're actually going to be making $572 on this position when you only have what? Your net debit here is $1,800, this is $2,000. So you're going to make 25% in the event of a 10% volatility increase. You're going subtracting the P&L in the event, subtract this negative number at the negative 199 plus the 577. So this is an interesting um, aspect to TOS. You can create your option structure, and then you can adjust your volatility in the event uh, your perspective on where volatility is going to be. Now you can also decrease it 10%. Now, in the event that volatility it goes up and volatility goes down, delta goes up, volatility goes down, you do have the potential of losing capital here. But that's the trade-off. We're going to be volatility neutral traders in this sense, um, because the Vega is not incredibly predictable. I would say that this structure here is a play that the typical professional trader will be in. A diagonal along with a long put vertical hedge. And then in the event that your high forecast in this area, prices starts oscillating in here between your close forecast and high forecast, you're benefiting from this theta here. If price sits in here, you're in that Goldilocks zone for this trade, and that's exactly where you want to be. And you want to extract this theta decay. You want to be in this position where this call is just sitting at the money here and just losing value over time. All right, thank you.